Welcome back, everyone. This is our Gold Weekly Review. My name is Angelo Zitis, and this week's title is Gold Reaches New Monthly High. Gold's price eventually performed a new run, as we noted in our previous report's title, and surged to a new monthly high. Gold's price action is rather impressive lately, as most market participants expected it to move lower as economies restarted operations. Yet, the precious metal did exactly the opposite. Now, this report is aimed at reviewing some important fundamentals that are possible gold price drivers. A lot of uncertainty surrounds the financial markets currently, as even though economies around the world are showing evidence that their activities have been increasing, governments and central banks do not seem to be backing off their somewhat aggressive approach. Today in the European morning, the PMIs from France, Germany, and the Eurozone confirmed that manufacturing and services sectors saw significant increases in June. In France, it was even confirmed that they have moved out of contraction circumstances as their reading surpassed the 50 level, which is considered a threshold. The Eurozone and Germany still need time for that level to be achieved, but the figures point to improved circumstances. However, during the EU summit that took place in the past weekend, there was no final note on the much talked about economic rescue package worth 1.85 trillion euros. On the other hand, the US Federal Reserve has divided analysts with its latest corporate bond buying program in addition to ETFs. Analysts believe that the move increases economic risk, as it is an indication of aggressiveness for risk appetite. Also, further stimulus measures are expected by the US government in the next months, according to Lawrence Kudlow, the director of the United States National Economic Council. In our view, and reading between the lines, the actions taken by the EU and the US government and the Federal Reserve tell us that a huge gap exists within their economies at the moment that needs to be amended as soon as possible. So even though they could insert more money in their economies, we could also understand that risks are elevated and could remain this way for the rest of the year, even moving into 2021. The news tends to make gold's price more expensive, as risks could stay with us for the long term. On another front, some headlines in the media insist a second wave of coronavirus cases is possible. Coronavirus cases in the US and Germany saw an increase in the past weeks, and the fears over the situation getting out of control are still in place. Officials, on the other hand, insist that such a scenario to materialize is not probable. However, as long as a vaccine has not been developed yet, safe haven assets, especially gold, could continue to move higher. On a separate note, the USD, which tends to keep an adverse relationship with gold's price, was evidently weaker yesterday. According to the dollar index that displays the power of the greenback against other major currencies, USD lost most of the ground it had gained in the last two daily sessions of the past days. And this could be due to weak financial data from the US yesterday that may have helped gold's latest rally higher. Gold traders should have in mind that on the 25th of June, we get from the US the final GDP for quarter one and the weekly initial jobless claims figure, which are potential market movers. On Friday, the 26th, we get the University of Michigan final reading and the consumption adjusted reading, which are rather important and could move gold's price. Moving now to our technical analysis, this is gold's 4-hour chart. Now, gold's price maintained a sideways movement yesterday between the 1765 R1 and the 1745 S1 lines. The precious metals price action tended to follow initially the upward trend line incepted since the 19th of the month, yet in the American session a clear sideways movement broke it. As the pair seems to have clearly broken the pre-mentioned trend line, we switch our bullish outlook in favor of a sideways movement temporarily. Should the bulls regain the momentum in gold's direction, we could see it breaking the recent high of the 1765 R1 resistance line, which contained its price in the past few days, and aim for the 1790 R2 resistance line, which marks a high since 2012. Yet, if gold's traders' bullish appetite is strong enough, the 1800 round number level could become a target prior to our R3 1810 line. On the flip side, should the bears take over, we could see the precious metal breaking the 1745 S1 support line and aim for the 1720 S2 support level. In the ultimate bearish scenario, gold's price could return to the 1700 level and aim for our S3 1693 line. Please note that the RSI indicator below our chart seems to imply that the bulls are continuing to lose power, yet are still present. Now, if you've heard something in this report that you found useful, make sure you apply it to your trading. That's the whole point. Thank you very much for your time and enjoy solid trading.